on both those stations. And welcome to another episode, or maybe your first episode of Forex Friday, where we take a look at the currency markets, what is happening to the different money around the world. How is it moving? How is it trending? How is it affecting not only Forex traders, but commodity traders and equity traders as well? We are looking at different ways to trade money for money. So I love the Forex markets, biggest market in the world. If you've been joining us for the past few months, you know that we've been dealing with a lot of fluctuation. There's no doubt. Ultimately, what we have are a lot of different, make sure my audio is good. All right, there we go. We're dealing with a lot of fluctuation right now, not necessarily because the central banks are doing anything particularly unique, but because the way in which the world is responding to what the central banks are doing, the different global economic slowdowns and things of that nature. So, hey there, Deborah, Diamond, John, great to see you all. And if you do have any questions, let me know. I can see the chat room. We like to make this as interactive as possible. So let's get to it. Now, I do have some notes that we're going to talk about here today from my handy dandy little notebook. And the conversation is going to come back to the Aussie. Now, what's really interesting here as we are mid-June going into July and comparing it back to February's trades, how much have these calm dolls just done a 180? And I think that when we take a look at what's been happening in the Forex markets, sort of the shifts that we're seeing, one of the things that I'm having to do right now, as we're trying to figure out what currency is going to gain traction against another, what currency is the leader in terms of relative performance to the upside, what currency is the laggard, meaning the weakest, or you can look at it as the leader to the downside. I mean, relative outperformance can be directional. So the question is, which currencies are really going to take the wheel? Which ones are really at the helm right now? And I think we can definitely see that the Australian dollar is part of that conversation. New Zealand dollar is going along, Canadian dollar is going along, which means our calm dolls are quite strong. And if you look at what's happening with equities around the world, or as I've been calling them lately, stonks, because they are just juiced by the central bank activity. They are juiced by ballooning balance sheets around the world. It's not just the U.S. Federal Reserve, it's central banks around the world, Bank of Japan, European Central Bank, etc. So what we have is essentially a very strong stock market, not necessarily strong economies, but the currencies are following along with the risk appetite in stocks, in the equities. And when you see movement like that, you're going to see certain pairs and certain individual currencies do certain things. Australian dollar, strong. Japanese yen, weak. The amount of US dollar printing that's happening in the US is causing the dollar to probably take its biggest dip in some time. Mainly because, frankly, the dollar is losing credibility, as is the US central bank. I mean, just the rate at which we're printing is, lunacy. So ultimately, what we've done, and the notes that I've got here, I know you probably can't read them. Maybe you can. All right. So I keep all my trades on index cards. That's why I have a little binder of index cards. And the one that we're going to talk about today is the Aussie US. But while we're talking about the Aussie US, let me give you a little sneak peek of something that we do for the Forex Mastery folks. And by the way, I mean, if you're ready to take a deep dive into this, one of the things that I do is, I know there's a funny little reflection there, but one of the things that I do is I use a service where I can keep notes and share them with members. Now, these are the notes from yesterday. You can kind of see them there. Pretty cool. And you can keep up with all the different notes that I'm taking, the different pairs. And that's something that we just sent out to members today. So that, by the way, if you're interested, it's over at simplertrading.com/Forex. Or is it FX? I'll have to check. All right. You can check them both out because one of them is my Forex Freedom class, which is up till now the most up-to-date, thorough look at everything that I'm doing Forex with an emphasis on volatility. And then we have our Forex Mastery. All right. So what's been so difficult lately? Because I won't say that Forex has been smooth sailing. You guys have been with me these past few, gosh, I guess months now. And you know the way in which from February to March, March to April, April to May, we've seen some massive seismic shifts. I think none more so than the total 180 in the Australian dollar and even arguably the US dollar, which were exactly the opposite of how I'm trading them right now, just February, March, April. So the trade that I'm going to talk about with y'all today and discuss the different risk levels as well as different entry levels and some of the tools is the Australian dollar and the daily time frame. So if you want to pull it up later on, let me know. Yeah, thank you. Thank you. Excellent idea with the index cards. Oh, I could even, there's another tool that I use. You can get this on Amazon. My friend, you can get this on Amazon, Gary. So what it does, it's a sheet that's 3 rows or 4 rows down, 5 across, and you can slip a 3x5 in each one of these little pockets. And it's transparent. And you can just put them all on your desk. It can serve as sort of a desk mat, if you will. You can, put your different cards and track all your positions via index cards. But yeah, I like to keep these like this. So that way, when there's something new to add to each trade, I've got one card, sometimes, 2. I can do one card per trade. The other style of card that I like to use, although they're a little fancy, is Levenger's has this very cool, that would be where my trading ideas go. And then the back is like a dot matrix kind of print. You can kind of see it. And I'll keep a lot of general notes there. So we can really get kind of geeky with the note taking. But, a lot of traders want to digitize everything. I'm not a fan of that. Something happens when you pick up a pen and write on paper. Something definitely happens. So Australian dollar, US dollar. I'm going to give you the price level that I'm looking at, and we'll do a little bit of a deep dive. So it's a 67.85 buy. 0.6785 buy on the Aussie versus US. Now, if you're tuning into this and you're a futures trader, sure, you can not use that price level, but you can use this trading idea for the 6A. If you're an ETF trader, or let's say you'd rather trade the FXA ETF, you can do that. Again, it won't coordinate with the price that I'm sharing, but the setup will coordinate. The setup will trigger a 6A buy or an FXA buy while it is simultaneously triggering an Aussie versus US dollar buy. So that level is one that I call moderate. So those notes that I was sharing with y'all, you can get these on your computer as well, but the neat thing is you can get the alerts and then you can also access these notes. And the way in which I've set out these alerts is sometimes as an aggro, which is just my shorthand for aggressive. There's a moderate, and there's a conservative. Now, a lot of folks assume that means probabilities. It doesn't. I do not believe in taking low probability trades. Either it's a trade that I want to deploy my capital within, or it's not. This idea that sometimes some trades can be low probability but yet low risk, I get that. I get the appeal to that. But if it's not a good setup, just because there's low risk, why would I take it? And I see a lot of that. I don't think I philosophically agree with it. I'm not saying it's right or wrong. It's just not my cup of tea. It's not my style. So moderate simply means it's of medium, moderate risk. Medium is what? It's really an arbitrary thing. Medium is reflecting that there's a risk above it and there's a risk below it. That's all medium means. It's not 50 to 100. It's not a certain number of pips or percentages. It simply denotes that there is a riskier trade that you can take and there's a less risky trade you can take. Now, aggro, high risk, moderate, sort of medium risk, and conservative is low risk. So it's high, medium, low, right? The idea that you'll always get medium to low risk entries is a misnomer. That's just not always going to happen. Sometimes the markets are on such a tear. Sometimes the trends are so strong. All you're going to get are aggressive or aggro entries. So the other reason we differentiate in the alerts and in the notes between the 3 types of entries is because I want you to know or be cognizant of how big or small your position size should be. Aggros should just typically be smaller because there's a larger chasm from the entry to the stop loss. Okay, I don't mind getting stopped out. I've been stopped out, plenty of times over the last few months. That's what transitions oftentimes do. But as long as I'm cognizant of it's a transitional market, perhaps I want to be more conservative and place entries that don't have a lot of distance between the entry and the stop, I can get stopped out, but only lose a little bit. Very important. Or, again, let's say you like to scale in, which is something I like to do. At the aggro, I would scale in with the smallest position. At the moderate, I would scale in with sort of a medium-sized position. Sometimes I'll do like a 1, 2, 3. In futures, for example, 1 contract, 2 contracts, 3 contracts. In Forex, it might be 100,000, 200,000, 300,000. If you're doing minis, it would be 10,000, 20,000, 30,000. If you're doing micros, you get the idea, $1,000, $2,000, $3,000 notional value of that pair. So you have the smallest position from the entry that has the greatest risk. Now let's talk about risk from another point of view. And that is the point of view of we don't move our stop losses around. I think a lot of folks, a lot of traders, in the interest of keeping risk low, which I can completely understand, in the interest of keeping risk low, they will move the stop closer to their entry and then wonder why they got stopped out and then the market moved in their direction. They had the trade direction right. They probably even had the entry right, but they smothered the trade. How do we keep from smothering the trade? Well, those of you that took our Forex Freedom class know I use historical volatility. A part of what makes something agro, moderate, conservative is where does it fall along the lines of historical volatility. Who uses historical volatility, by the way? Using what kind of volatility have we seen over a longer look back? Historical. 6 months is what I use. Look, this is used by institutions. This is used by hedge funds. They typically use this kind of data to determine value at risk. We use it for support resistance and risk taking. How much risk are we taking? So we got the entry on the Aussie, 67.85. That's a live order that I'm working right now as a limit order to buy. It's a moderate entry, so it's not my lowest. It is moderate risk, right? It's also, again, the level. Let's talk about levels because we've talked about moderate, right? You can kind of see my notes there. Talked about moderate. We've talked about the different risk levels. Now let's talk about the different entry levels. So when you take a look at the Aussie versus US, you'll notice my level corresponds with a 34-period exponential moving average on the high. Now, pull this up if you'd like later on. If you're watching this during a recording, pause the recording, go pull up a chart on TradingView or whatever charting you're using, Thinkorswim, and pull up a daily time frame of the Aussie versus US dollar. Put the 34 exponential moving average on the high, the close, and the low. That's my 34 EMA wave. The level that I'm looking at is going to pull back to that, hence I call it moderate. Now, there's another set of tools that I use, and these are free tools, gang. They're freely available on TradingView. You can check them out under Simpler, search indicators for Simpler. They're called propulsion dots, Simpler propulsion dots. And what they do is they combine the wonderfulness of moving average crosses with an understanding of price, and they replace the moving average. So I do not use an 8, 13, 21 exponential moving average any longer. I use a simpler propulsion because it turns on and off based on whether the probability is that it will act as good dynamic support or resistance. So if I do not have propulsion dots lit up, and I do not on that Aussie US trade, I do not have the opportunity to take a 13 or 21 EMA entry. So check out that tool. It's really, really quite cool. I think we have some of the replays of the Forex webinars that I did before the class. And you know what? Next time I see you all, I'll see if I can't make that replay available for you guys so you can check out some of those tools and what I use. And like I said, they're free on TradingView. So pull them up on your chart, take a look at them. Clearly you have to know how to use them, but you can at least get a visual representation of what I like to do on my charts. How I like to upgrade, modernize moving averages and moving average crosses using simple coding that takes, again, the moving average cross as well as the relationship to price which is really the secret sauce here. But again, the indicator's free, check it out. But knowing the relationship back to price and whether or not that moving average cross is a good one, it's a high probability indication of momentum, is highly increased, much more effective when you look at the relationship back to price. So really a very neat tweak that we've done with that tool here at Simpler. Anyways, if I have a propulsion dot visible, then I know I could have an aggro entry. It's going to be an entry that requires a little less movement to get to it, which means there's more movement to get to the stop. Smaller reward, bigger risk, aggro entry. Now, aggros are also a level at which, again, not only can you decide to trade it with smaller size, but you can pass on it altogether, right? So I want to mention that one of the things that traders should be very comfortable with is saying, I know that's a good trade, I know that's a good level, but it's not affordable, or I'm not comfortable with that level. I mean, if you can trade with small size just to experience it, something about being in the market does fire off some different part of the brain, making some interesting memories and training the eyes. So even if you can risk very, very little, maybe it's a nano, just you're engaged, you're committed, you've got some commitment to that trade, give it a whirl and see if aggros are for you. Again, you can do this with very, very little risk, literally risking pennies, depending on how granular you want to get with your position sizing. One of the awesome things about the Forex market. So we talked about my index cards. What's the Amazon item? Take a look at 3x5 card holder. I don't have the name of the product. It's a $15 sleeve of 3x5 card holders. It's a transparent plastic tool or sheet. It's very cool. It's very simple. It's tech. It's my version of tech. All right. Let's see what else we have here. So that's the Amazon item. Cool with the index cards. Let's see. You guys have any questions here? Oh, we're actually just about wrapping up. Yeah, look. Yeah, I'm sorry about that, Gary. I don't remember the name. Hey there, Noy. Yeah, John Slade Tesla again. Absolutely. You know, some of us have certain. I think each one of us have a particular symbol where the trading light just shines on us. And yeah, I think every trader is going to probably have a Tesla-esque type story. Hopefully, you guys will find your Tesla. Maybe it's in the Forex markets. You know, I think some of my biggest trades for me personally, have come in futures and Forex. Those are my Teslas. But yeah, absolutely. It's great when our team is just slaying it. And what a time this has been. We're in a historic asset bubble again. I think that's one of the reasons this Aussie trade is going to continue to rock. So check it out, and I will see you all in the next episode of our Forex Friday. Thank you as always for being here. I'll talk with you soon. All right, gang. Be good to each other.